that debasement of the denominator, the value of fiat currency, means that gold automatically rises. So I'm pretty positive gold, but it just doesn't trade well. It's kind of weird. It keeps trying to break higher and then fails, and tries to break higher and fails. So that keeps me from being very allocated towards it. And I think, cryptocurrencies are actually a much better bet for this.
As long as the war in Ukraine continues to rage on, putting more pressure on the existing supply issues around the world, the uncertainty around many asset classes will persist. Add that to the increased risk of a global recession with inflation at a 40-year high in the United States and a 30-year high in the United Kingdom, and things look even bleaker, probably for the rest of 2022 and beyond. In a recent interview, Real Vision CEO and co-founder Raoul Pal discusses his outlook for various asset categories using the ongoing geopolitical tension and macro issues as a backdrop. The macro guru explains that the dollar is currently in a precarious situation as a reserve currency, meaning other central banks are turning to the nearest alternative, gold. He adds that with the high cost of goods and services, governments might have to roll out more stimulus packages, which would mean further debasement of fiat currencies. The result of these events is a further rise in gold. Powell also talks about cryptocurrencies, which he believes will fare better given the situation of things, bonds, equities, and commodities. If you were interested in Powell's outlook on any of these asset categories, please watch the video to the end and click the like button. Also, remember to drop your comments and observations in the comment section below. We appreciate all our viewers and subscribers for their immense contribution to our growth.
So, I know you've been talking about sort of certain haven assets at the moment, but and I'm sure we'll touch a number of them, but, gold, bonds, let's kind of just walk through those very quickly, the traditional haven assets. How do you see those markets developing, and what are your thoughts on those at the moment?
So gold is pretty straightforward. It trades like shit, but over time, there is a very strong case for other central banks to increase their reserves in gold because of the fact that gold is nobody's liability and the dollar now clearly is. So I think that creates a secular backdrop. The other outcome, I think, that if I'm right about global economic weakness coming, there will be more rounds monetary stimulus, but maybe in clever ways, i.e. handing it out to people who can't afford their electricity bills, but it's still the same bloody thing. Or yield curve control, still the same thing. So that debasement of the denominator, the value of fiat currency, means that gold automatically rises. So I'm pretty positive gold, but it just doesn't trade well. It's kind of weird. It keeps trying to break higher and then fails, and tries to break higher and fails. So that keeps me from being very allocated towards it. And I think cryptocurrencies are actually a much better bet for this. In terms of the bond market, I've just put out a tweet thread about this morning, there is a 35-year channel I call the chart of truth, where 10-year bond yields go up and down in this regression channel. And when you get to the top of the channel, it's usually the end of the cycle. And the end of the cycle, yields are lower every time because more debt gets added to the economy every time yields go down. So therefore, a smaller rise in yields breaks the economy and things slow down. And also demographic demand. As the population ages, they tend to buy more bonds because it gives them security in retirement. That's another big factor. Demographics tend to slow down the trend rate of growth. So that brings that. So this chart is a meaningful thing. It's not just a chart of an asset. It's actually a big secular framework of understanding of where the world is. So we're right at the top, poking through the top of the channel. We poked through in 2018 and everyone said inflation's going to 6%. What happened was growth started falling. And usually the yield curve inverts when that chart is at its peak. And that's exactly what's happening now. So this looks like every single other cycle I've ever seen, where everybody gets excited about breaking the channel. Everyone goes, everything's changed. The yield curve inverts and everyone goes, forget the yield curve. It doesn't mean anything. And it plays out. So I'm, more of a buyer than bonds. I bought some call options on bonds, but I will probably over the next few months look, because I think growth means lower yields.
And then let's move to equities and commodities. What are you seeing there?
Equities, I thought they based a week or so ago, based on a number of technical signals that I have. Also, I looked at the chart pattern of equities around Fed rate rises or reduction in the balance sheet. And they basically form the same kind of W pattern every time and then rally and go to new highs. So I'm like, is this any different? Probably not. And that's been every single one over the last 20 years has done the same. The only one that was slightly different was 2018, and that's when the yield curve had just inverted and we had a liquidity shock. So I've thought there is a 60% probability the market just goes up, and there's a 40% probability we have another shock lower based on whatever it could be. Let's say scenario 2 in the Russian scenario might cause that. And then we might see liquidity in markets dry up, and that the market could then be starting to price in the recession. We don't know when recession comes after a yield curve. It can be almost immediate, or it can be 2 years away. The yield curve inverted in 2006, and it wasn't until 2008 that we saw the full recession. So not really clear. Again, probabilistic is the only way of looking at it. But equities, I think, are most likely to go higher.
Pal also predicts that there will soon be a drop in bond yields, which would impact other assets, especially tech stocks and cryptocurrencies. On commodities, Pal says he's not very bullish. He explains that there is an ongoing supply crisis for commodities, an existing issue that the war in Ukraine has further worsened. He adds that this could mean a larger long-term cycle for the asset class.
The other part of that framework is, if I'm right that bond yields start to go down soon and peak inflation fear is in, well, that's what's beaten down all the tech stocks. Peak inflation fear, and probably same with crypto too, because long duration assets tend to do less well. So we should see those at the margin start to outperform, and we're starting to see evidence of that. So that's how I'm thinking of that. Commodities, much more difficult, because we're in this supply shock world. There is not a lot of supply around. There is not a lot of store of commodities. China hoarded a bunch. So could this be the start of a larger long-term cycle in commodities? So not sure yet. Not sure. What I have learnt is that over time, technology increases supply that lowers prices. That has tended to play out over 10-year time horizons, commodity bull markets. Is this a structural commodity bull market? Well, the last one was driven by demand, which was China. China coming onto the world stage demanded all the commodities. This time it's not demand, it's all supply. So I think it's more fragile. So I'm not sure.
Pal also talks about the ongoing energy crisis in the European Union, a viable solution to the problem, and how he sees everything playing out in the coming months.
Yeah, there was I think it was in the FT today, the Prime Minister of Spain was saying to the EU, we need help because their electricity prices are basically pinned to spot gas prices. So they've got a huge rise, and they're like, we need to subsidize our industry, and it'll also be for the people. So if you're fighting a war, particularly if Russia stays in Ukraine, they're going to have to say to the people, we acknowledge the fact that this is a political situation and we have to help you. Now, and they'll purposely not give handouts to the rich. It's going to be QE for the people. Now, does that create more inflation? So what would be the answer? The answer is usually yield curve control. That's what the US did in the 1940s and 50s, 30s, 40s, 50s, where you cap yields. So bond yields don't destroy the debtors. Inflation eases the debt burden, and you still stimulate the economy. So Europe, you've got the green push, and then you, let's say, have transfer payments. Not unlike what happened in the 30s, 40s, and 50s. And what happened was growth. Growth came, and the economy grew its way out, and inflation actually started strong and then slipped away. So it's not sure that it's necessarily massively inflationary, but it probably is inflationary for assets, because if you're printing more of the denominator, it goes down in value.
We might see several of the scenarios play out in the coming months, but many of them are dependent on how the Fed will approach its promise of further economic tightening in 2022. The previous 25 basis points increase had a profound effect on the market. However, there is still a lot of uncertainty regarding how many asset categories and investors will react to the promised 6 or 7 more interest rates hikes. Our best bet right now is to keep stacking those cryptos as much as we can. Thanks for watching the video. Remember to drop your comments below and hit the like button.